Tenemos con nosotros a Brian Vendig, President of MJP Wealth Advisors. Brian, thank you so much for having us a few minutes. I think the sound now it's good, it's better?
Yes, thank you.
Perfect. Brian, inflation continues to rise. Year over year, the price of consumer goods and services has risen 8.6%. Month over month, inflation increased 1%. In May, it's stronger than expected and stronger than the CPI seen in April. Economists expected to see some cooling in core inflation, but that didn't happen. How do you see this data, and how could this recent inflation data redirect the Federal Reserve roadmap?
Sure, thank you. That's a great question. I think with the impacts of inflation that we've seen in the short term, month over month, year over year, the market now is definitely pricing in the expectation that the Fed is not going to ease back anytime soon on the rate increase cycle. They telegraphed that they were going to increase interest rates 0.5% this month, as well as 0.5% in July. I think it's pretty much a done deal that they'll increase interest rates again another 0.5% in September. And that's what we really see being priced into the market right now, is the risk of the rate cycle continuing at a higher pace for a longer period of time. I think, unfortunately, with the data and also probably influenced by higher energy costs increasing around the world, as well as the impact of the China lockdown, I still find it surprising that last month in May, the Federal Reserve took higher rate increases off the table for the month of June. I think, as I've commented in the past with you, that we were looking for higher rate increases in June due to the China lockdowns and the impacts on the supply chain. So we'll see where the Fed commentary is next week. As they have said in the past, they are data dependent and the data is coming in hotter. So I think the market would welcome a higher rate increase in the short term to accelerate the cycle of the rate increases, but also I think the Fed needs to provide updated commentary about their outlook for inflation in 2023 and 2024, because getting down to 2% just seems completely abnormal when we look at the supply-demand imbalances around the world right now, driving that headline inflation number.
And what about next monetary policy meeting next week? We will know the Federal Reserve decision, and now we are expecting 50 basic point rate hikes, but in July markets are increasing its bets. Traders price a 50% chance of 75 basis point Fed rate hike in July. What do you think about next week and about the monetary policy meeting of July?
Yeah, absolutely. Like I said before, I think the Fed needs to take control of market expectations right now and maintain their credibility. They need to act in a decisive manner with Fed policy, whether it's increasing interest rates 75 basis points in July, or even revising their previous commentary and have swift action in June, just to maintain credibility. We do not want to see the Fed lose credibility with the markets and have the markets move ahead of Fed policy. So I think right now that's the main risk that we're seeing in the market, is this interest rate or credit risk. I do still think, though, over the balance of the year, believe it or not, that headline inflation still has a chance to come down through a combination of demand destruction from the consumer, as well as we are seeing data that the supply chains are getting more efficient around the world, but different sectors, different parts of the supply chain take a little longer to heal than others relative to industry. So, you know, we're sitting at numbers right now, obviously over 8%, but I still think there's a possibility that we'll get down to 6 by the end of the year. And if that does happen, then over the course of the year, we should see a tone from the Federal Reserve change. But at the same point in time, I think this month, as well as in July, we really need to hear a little bit more from the Fed about how they're going to use their tools to combat inflation. And as I said before, hopefully revise that outlook for inflation expectations in 2023, 2024 to be very much, I would say, hopefully more aligned to what we just heard recently this week from the ECB, for example, who's forecasting out inflation for Europe next year at 3.5%. You know, that seems a little bit more reasonable, I would say, than a 2% target that the Federal Reserve is holding domestically here in the U.S.
Well, we will remain checking all of these and see the evolution of inflation, and of course awaiting the decision of a monetary policy meeting next week from the Fed. Thank you so much, Brian Vendig, President of MJP Wealth Advisors. A pleasure.
Thank you.